Welcome to the Deep Dive, where we take all the noise from earnings season, the calls, the reports, and boil it down to what you really need to know.
And today we are jumping into Powell Industries, ticker POWL.
We're covering their fiscal Q4 and full year 2025 results, and this was quite a report to unpack.
It really was. This is essential listening because Powell is, well, it feels like they're at an inflection point. They're coming out of this major transition, and the numbers they just posted seem to validate that entire strategy.
Okay, so let's start with those headline numbers, because they were, frankly, spectacular.
Yeah, they really were.
For the fourth quarter, revenue hit $298 million. That's up about 8% year over year. But the profitability was the real story. Record diluted EPS of $4.22 per share.
And that's not just from volume. It's the execution. They hit a record quarterly gross profit margin of 31.4%.
31.4. I mean, to put that in perspective for everyone, that's a jump of 215 basis points from last year.
Exactly. That's a huge, huge leap in efficiency, a massive operational win, as you said.
And the full year holds up, too. We're looking at revenue just crossing that $1 billion mark, $1.1 billion, up 9%.
And this is what should give you confidence looking forward. The pipeline. They ended the year with a backlog of $1.4 billion.
Which is a fantastic number.
It is. And the book-to-bill ratio for the full year was exactly 1.0. Perfectly balanced. They're replacing every dollar of revenue they ship.
But there's a detail in there about the quality of those new orders that I found fascinating. Management made a point to say that the $271 million in Q4 orders had 0 mega projects.
Yes. And that is such a critical signal.
Why is that so important?
Because mega projects are lumpy. They can skew the numbers for a quarter, they're high risk, and then they disappear. Getting this kind of volume from smaller and medium-sized projects, it suggests a really broad, healthy, durable demand.
So it's more stable, more predictable.
Much more. It gives you a much higher quality of visibility heading into fiscal 2026. It sets a really cautiously bullish tone.
Okay, so speaking of sustainability, let's drill down on that incredible 31.4% gross margin. Was that just a one-time fluke, or is this the new normal?
That's the million-dollar question, right? And management was pretty clear on this. The 31.4% was exceptional, but it did get a significant, let's call it a non-recurring boost.
Okay.
It came from a combination of strong project execution and what they call favorable project closeouts.
Let's pause there. A favorable project closeout. What exactly does that mean for our listeners?
So think of it like this. On a big multi-year project, you estimate your costs along the way. When the project finally finishes, you square everything up. A favorable closeout just means you were way more efficient than you originally planned.
So you spent less money and you get to book that difference as profit right at the end.
That's it, exactly. And they quantified it. Those closeouts added about 100 basis points, so a full percentage point, to that Q4 margin.
So if we strip that out, the underlying operational margin is still north of 30%. Still incredibly strong.
Oh, absolutely. The baseline efficiency is fantastic. For the full year, the gross profit was 29.4%, and that had about 125 basis points of closeouts in total.
So what are they guiding to for next year?
They feel that margins in the upper 20s are realistic for fiscal 2026. So think 28, maybe 29%. That's driven by stable pricing and just better execution.
Okay, let's pivot to expenses. SG&A was up pretty big in the fourth quarter, something like 25% year over year. What was that about?
Yeah, that number definitely jumps out, but it's mostly noise. About $3 million of that was a variable compensation catch-up.
Ah, year-end bonuses, paying for the great performance.
Exactly. And then there was just under $2 million in legal and valuation costs from the Remdidec acquisition.
So nothing to worry about long-term. This was a one-off.
Correct. Management is actually targeting leverage there. They expect SG&A as a percentage of revenue to come down from the 8.6% it was in fiscal 25.
Interesting. And at the same time, they're stepping up R&D spending.
They are, up 17% to about $11 million for the year, and it's a very targeted investment.
It's all focused on that 0 to 38 kV distribution strategy. Why is that specific voltage range so important right now?
That is the sweet spot for grid modernization. It's the medium voltage gear you need to connect things like utility scale solar farms or battery storage to the grid. It's an area with massive mandated spending coming down the pike.
So they're skating to where the puck is going, basically.
That's the idea. They expect to see real commercial results from that investment starting this year in FY 2026.
Now, this is where it gets really interesting for me, the balance sheet.
Yeah.
Powell is sitting on $476 million in cash and short-term investments.
And here's the kicker.
With zero debt.
Zero. That is their financial superpower. It gives them incredible flexibility. They generated $168 million in operating cash flow this year alone. They can fund all of this growth themselves.
And let's talk about that growth, that pivot, because it's a whole story here.
Yeah.
5 years ago, this was an oil and gas company. The utility and C&I sectors were, what, under 20% of their backlog?
Barely a footnote. Now, those two segments are 41% of their revenue for this past year. And even more importantly, they make up 48%, almost half of the total $1.4 billion backlog. That is a fundamental structural shift in the business.
That's diversification in action.
It absolutely is, and it de-risks the company from that volatile energy cycle. Just look at the utility segment revenue doubled in Q4 year over year.
Doubled.
Management called the demand broad and durable. And for the first time ever, the utility business and the oil and gas business are equally weighted in the backlog, about a third each. That balance is critical.
And the other growth engine is C&I, which is really a story about data centers.
It's all about data centers. This is Powell plugging directly into the AI boom. The biggest problem for AI right now isn't chips, it's power. Getting enough of it and making sure it's reliable.
And Powell sells the gear that does exactly that.
Exactly. The switchgear, the controls, they're seeing projects get bigger, more frequent, and they said about half of their 15% C&I backlog is specifically for data centers.
We also saw some surprising strength in traction power.
Yeah, that nearly doubled. That's really about timing. You're seeing a bunch of big light rail projects in places like the East Coast, Chicago, and Canada all happen at once.
Right. So you have this healthy company, pristine balance sheet, successful diversification. Which brings us to their big move, the capital allocation.
This is the high conviction bet. They announced a $12.4 million investment to add 335,000 square feet of capacity at their Juneau Port facility in Houston.
And this isn't just for general growth. They were very specific about why they're doing this.
Laser focused. It is, and I'm quoting here, to support the incoming wave of anticipated LNG project development work.
So they are betting big on the US LNG export boom.
They are. They're looking right past any near-term political noise or timing delays and investing for the demand they see coming over the next 3 to 5 years. This is a massive multi-year theme.
So add that $12.4 million to their normal maintenance spend, and you're looking at close to $20 million in CapEx for fiscal 26.
A huge vote of confidence. And that's just the organic side. Don't forget they also closed the acquisition of RemDeck in Q4.
Right. What does RemDeck bring to the table?
It's not about buildings, it's about technology. They bring high-margin electrical automation tech. Management is already talking about quoting that technology to their existing utility and data center customers. It's an accelerator.
Okay, so let's put it all together for an investor. That $1.4 billion backlog is great, but how quickly does it turn into revenue?
Fantastic question. They gave pretty clear guidance on that. They expect about 60% of that backlog is convertible into revenue in fiscal year 2026.
60%. So a huge chunk of next year's revenue is already locked in.
It de-risks the year significantly.
What about competition? With margins this high, aren't rivals trying to undercut them on price?
Management said the market is running at different speeds. In those hot markets like utilities and data centers, where speed is everything, pricing is very stable, customers need the gear now.
But not everywhere.
Not everywhere. They did note some softness in legacy oil and gas subsectors, like the UK North Sea, where things are a bit more price sensitive, which just reinforces why the diversification strategy was so smart.
And the elephant in the room? The timing on those big LNG projects.
They were upfront about it. They acknowledged the restart has taken a little more time than they hoped. But they stressed that their confidence in the long-term fundamentals is unshaken. They're investing for the 2027-2029 wave, not for next quarter.
One last thing. They did warn about a softer Q1, right?
Yes, a standard seasonality warning. The October to December quarter is always a bit slower due to holidays and plant shutdowns, but the full-year outlook, because of that backlog conversion, remains very strong.
Okay, it is time now for our not financial advice segment, where we take all this data and pitch one wild but plausible trade idea.
Let's do it.
We have incredible financials, a huge strategic pivot that's working. What's the asymmetric opportunity here?
I think the opportunity comes from a market mispricing the transition.
The street still sees them as the old cyclical oil and gas company?
I think so, even though the numbers, the backlog, the revenue mix tell a completely different story. So the thesis is this. Powell isn't a cyclical ONG supplier anymore. It's a mission-critical infrastructure provider for two of the biggest secular growth stories out there.
US LNG exports and the AI data center buildout.
Two massive multi-decade themes. But the market today is focused on the near-term noise, a slight delay in LNG timing, a little softness in petrochemicals. That's the entry point.
So what's the trade?
The trade would be something long-dated and asymmetric. For example, buying the $5 calls expiring 2 years from now. This isn't a bet on the next earnings report.
It's a bet on the 3-year strategy playing out.
Exactly. The logic is that the market will be forced to re-rate this stock. Once that 60% backlog conversion delivers another great year, and then the massive LNG work starts hitting in 27 and 28, the story changes. The multiple has to expand.
So you're essentially buying the successful execution of this dual-engine strategy at today's prices, which you believe are discounted due to short-term impatience.
That's the idea.
A fascinating long-game trade. And of course, a reminder to everyone, that is for informational purposes only. This is not financial advice.
Absolutely not. Always do your own research and consult a professional.
So to wrap up our deep dive on Powell, we have record profits, a fundamental business mix shift toward utilities and data centers, and a huge strategic bet on the coming LNG wave with their Juno port expansion.
And that leads me to the final provocative thought I want to leave you with. Powell has nearly $500 million in cash, zero debt, and they're plowing capital into high-return organic projects.
Right.
They are fueling this incredible LNG and data center growth strategy entirely with their own cash. So the question is, how long can they maintain that perfect balance sheet? And does all that dry powder signal that management is on the hunt for another, maybe even bigger, acquisition to accelerate their strategy even further?
With that much cash and no debt, they are one of the most flexible players in the entire energy transition space. A lot of optionality there.
A tremendous amount.
Thank you for joining us for this deep dive. We hope this gave you the shortcut you needed to be truly well informed on this pivotal earnings report.